Today, we are pulling back the curtain on the hidden machinery that powers our entire global economy, the modern banking system. It's this incredibly complex world, a system that's so deeply woven into our daily lives that most of us just take it for granted. But understanding its architecture, how it's built, how it actually makes money, and more importantly, where its weaknesses are, is absolutely crucial if you want to understand how money, credit, and the economy really work. So let's get into it.
But before we jump in, don't forget to like, share, and subscribe, and check out the links in the description if you're looking for a real estate agent in your market or you need life insurance. My team and I can help you anywhere nationwide. Okay, so to really wrap our heads around this topic, we're going to tackle it by building what I like to call a foundational pyramid. We're going to start with the absolute basics at the bottom and build our understanding up, layer by layer. We'll start with the core functions of a bank, then get into the magic of how money is literally created. We'll look at the bank's profit engine, then the critical difference between liquidity and solvency, then the anatomy of a bank crisis, and finally, the role of the ultimate guardian of the system, the Federal Reserve.
All right. Let's kick things off with part one, the core banking functions. Look, before we can even begin to understand the crazy dynamics of a financial crisis or what the Fed is doing, we have to start with the basics. We need to know the simple, essential jobs a bank is designed to do in the first place. This is the blueprint of the whole machine. At its most fundamental level, you can think of the entire banking system as a kind of intermediary. It's like a giant financial bridge. On one side of the bridge, you've got the savers. That's people, companies, anyone with extra cash they want to keep safe, maybe earn a little interest on. On the other side of the bridge, you have the borrowers, families who need a mortgage, students who need tuition, entrepreneurs who need capital to start a business. A bank's number one job is to stand right in the middle of that bridge and connect those two sides, moving capital from those who have it to those who need it. So how do they do that? Well, they have four essential functions. Now, the first three are things we all see every day. First, they accept our deposits into checking accounts, savings accounts, CDs, you name it. Second, they make loans, mortgages, car loans, business credit lines. And third, they facilitate payments. Every single time you swipe your credit card, send a wire, or get a direct deposit from your job, there's a bank in the background making that happen. These are the visible parts of the machine. But it's that fourth function. That's the one that's the most critical, the most clever, and honestly the most dangerous. Maturity transformation.
And this brings us to the central paradox of banking. The fancy term for it is maturity transformation, but the idea is actually pretty simple. Banks borrow money from you on a really short-term basis. Think about it. Your checking account deposit is basically a loan you've given to the bank, and you can demand that loan back, in full, at any moment just by walking up to an ATM. But what does the bank do with that super short-term money? It lends it out long-term on things like a 30-year mortgage. So they're transforming a short-term liability, your deposit, into a long-term asset. This fundamental mismatch, it's the very heart of their business model, but as you're about to see, it is also their greatest weakness.
That inherent mismatch is the perfect lead-in to part two, how money is created. This is where we pull back the curtain on the real magic trick of the banking system. We're about to see how the system doesn't just move money around, it literally creates new money, seemingly out of thin air, all through a process called fractional reserve banking. So let's start with a really basic question. When you think of new money entering the economy, what do you picture? Probably some government printing press churning out bills 24/7, right? And yeah, the government does print physical cash, but the vast majority of what we all consider money, the digital dollars in our bank accounts, that's actually created by commercial banks. Let me show you how. The whole system is built on this principle called fractional reserve banking. And the name really says it all. When you deposit money into a bank, the bank is legally required to hold only a fraction of that money in reserve. They can keep it as cash in the vault or on deposit with the central bank. The rest of it, the majority of your deposit, it doesn't just sit there. The bank is allowed, and in fact, it's incentivized, to lend that money back out into the economy. Let's make this real with an example. Just follow the steps here. Step 1, you get your paycheck and you deposit $10,000 into Bank A. Step 2, Bank A has to hold a fraction of that in reserve. Let's say the reserve requirement is 10%, so it holds on to $1,000. Step 3, now it has $9,000 of what are called excess reserves that it can lend out. So it makes a $9,000 loan to a local business owner. Step 4, that business owner doesn't just stuff the cash under a mattress, they spend it, maybe buying some new equipment. Step 5, the person who sold the equipment now has that $9,000 and they deposit it into their account at Bank B. Now, what does Bank B do? The exact same thing. It holds 10% of that $9,000, which is $900, in reserve and then lends out the other $8,100. That loan gets spent, deposited in Bank C, and the cycle just keeps repeating over and over and over again.
So what's the end result of all this? Think about it. Your initial $10,000 is still in your account. You can see it on your statement. But now the equipment seller also has $9,000 in their account, and the next person has $8,100 in theirs, and so on down the line. The original deposit is still there, but the banking system has magically created brand new deposits and therefore new money right on top of it. This is called the money multiplier effect. It expands the total money supply, and it's what fuels economic growth by funding new investments, creating immense leverage throughout the entire system.
So if that's how the machine is built and how it expands the money supply, the next logical question is, how does the bank itself actually make a profit from all this? So let's move on to part 3, and, well, let's follow the money. Okay, the main profit engine for almost any bank is a concept called the net interest margin, or you'll hear it called NIM. And it's actually really simple. It is just the difference, the spread, between the interest rate a bank earns on its assets, like all those loans it's making, and the interest rate it pays out on its liabilities, like your savings account. That spread, that's the fundamental business model of banking.
Let's look at a super simple example here. A bank might be lending out mortgages and earning, let's say, an average of 6% interest. At the very same time, it's paying you, the depositor, just 1% interest on your savings. That gives them a gross spread of 5%. Now, 5% might not sound like a ton, but when you multiply that little spread across hundreds of millions, or in many cases, billions of dollars in loans, it becomes an absolutely massive engine for profit. This is how banks make money off that maturity transformation we talked about.
Of course, that net interest margin isn't their only way of making money. Oh no. Over the years, banks have gotten very, very good at diversifying their income. They also bring in revenue from a whole bunch of fees. Monthly account maintenance fees, those really painful overdraft fees, fees for sending a wire. Every time you swipe a credit card, the bank gets a tiny piece called an interchange fee. And the really big banks have huge wealth management divisions. And they earn fees from a complex process called securitization, where they bundle up loans and sell them to investors. But even with all of that, the core profit engine, the real bread and butter, is still that simple interest rate spread.
Okay, so we've established the system is designed to create money and it profits from this interest rate spread that's based on maturity transformation. Now we need to shift our tone a bit because we're about to look at the inherent flaw baked into that very design. This brings us to part 4. And honestly, this is probably the single most important concept in this entire explainer: liquidity versus solvency.
If you only take one thing away from this today, let it be this distinction right here. Liquidity, that is all about the short term. It's a bank's ability to meet its immediate cash demands. Can it pay its depositors who want to withdraw their money right now? Solvency, on the other hand, is about the long term. It's whether the bank's total assets are worth more than its total liabilities. Is the bank profitable on paper? Here's an easy way to think about it. Liquidity is having enough cash in your wallet to buy groceries for the week. Solvency is having a positive net worth, meaning your house, your car, your investments are all worth more than your mortgage and your other debts. You can be totally solvent with a high net worth, but still be illiquid if all your money is tied up in things you can't sell quickly.
And that leads us to the most crucial point of all. A bank can be perfectly solvent. It can have a great portfolio of high-quality 30-year mortgages that are very profitable over time, but if too many depositors show up demanding their cash all at once, the bank can become illiquid and completely fail. It just runs out of ready cash. And this is not some theoretical risk. This is the mechanism behind pretty much every major bank failure in history, from the Great Depression all the way to the collapse of Silicon Valley Bank. It is almost always a liquidity crisis, not a solvency crisis, that starts the fire.
This sets the stage perfectly for Part 5, the anatomy of a bank crisis. This is the moment we get to see what happens when that inherent flaw, that deep reliance on maturity transformation, gets suddenly and violently exposed. This is what it looks like when the system fails. It all starts with the loss of one single, invisible ingredient: confidence. The entire fractional reserve system is built on this collective belief that your money is safe. But what happens when a rumor starts? When depositors hear that their bank might have made some bad investments or is facing huge losses, the only rational response for any single individual is what you see on the screen: I need to get my money out, now. It doesn't even matter if the rumor is true. The fear itself becomes the trigger for what we call a bank run. And from that one little spark, a terrifying cascade begins. Now, in the old days, this took days to play out. Day 1, rumors spread. Confidence starts to erode. A few people quietly pull their money out. Day 2, the news travels, and you see lines forming at the teller windows. Withdrawals pick up speed. But in the modern world, with mobile banking and social media, this timeline is compressed from days into mere hours. Billions of dollars can be withdrawn with just a few taps on a phone. The bank quickly burns through all its liquid cash. Then, to meet the withdrawal demands, it's forced to sell its long-term assets, those bonds and mortgages, in a fire sale. It has to sell them at a huge discount, which means it's booking massive real losses. And at this point, the problem transforms. Those losses just destroyed the bank's capital. What started as a short-term liquidity crisis has now become a long-term solvency crisis. And finally, depositors at other banks see this happening, and they start to get scared. They start wondering, is my bank safe? And they start pulling their money too. That is contagion. And that's how a single bank failure can threaten to take down the entire financial system.
So the key takeaway here is this: no bank, I don't care how healthy or well-run it is, can survive a full-blown bank run. Why? It all goes back to maturity transformation. You simply cannot sell a 30-year mortgage or a 10-year treasury bond overnight for what it's worth, especially not when you have to sell billions of dollars of them. A bank's assets are long-term and illiquid, while its liabilities, your deposits, are short-term and can be demanded at any second. The very design of the bank is what makes it so vulnerable.
We're about to explore the powerful institution that was designed specifically to prevent these crises from happening. But first, if you're finding this explainer valuable, please do me a favor and take a moment to like, share, and subscribe. And as a reminder, if you're looking for a real estate agent in your market or you need life insurance, my team and I can help you anywhere nationwide. All the links are right there in the description. Okay, so that inherent fragility in the banking system brings us to our final section, Part 6, the Federal Reserve's role. Because the system is designed this way, an external force had to be created to manage it, to act as a stabilizer, and to stop individual bank failures from becoming total systemic collapses. And that force, of course, is the Central Bank of the United States, the Federal Reserve, the system's ultimate guardian.
Now, the Fed has an official dual mandate given to it by Congress. First, to maintain price stability, which basically means keep inflation under control, and second, to foster maximum employment. But beyond those two official goals, it has a couple of unofficial but absolutely critical roles. It serves as the lender of last resort, the one institution that can provide emergency cash to a bank in the middle of a liquidity crisis. And more broadly, it acts as the primary stabilizer for the entire financial market.
So, the big question is, how does it actually do all of this? The Fed is an unbelievably powerful institution, but it doesn't just wave a magic wand. It has a very specific set of tools that it uses to influence the economy and the banking system. So let's break down the most important ones.
All right, the Fed's primary and most famous tool is the federal funds rate. Now, this is the interest rate that banks charge each other to borrow money overnight just to meet their reserve requirements. So why should you care about a rate between banks? Because this rate is the bedrock for the entire financial system. It influences every other interest rate in the economy, from your mortgage rate and your credit card APR all the way down to the interest rate on your savings account. You can think of it as the master lever of monetary policy.
It's pretty simple. When the Fed wants to cool down an economy that's running too hot and fight inflation, it raises this rate. That makes borrowing more expensive, which slows down spending and cools off economic activity. But as we're about to see, it also puts a ton of stress on the banking system. On the flip side, when the economy is weak, the Fed cuts rates. That makes borrowing cheaper, which is meant to stimulate spending, increase the amount of liquidity in the system, and encourage banks to lend more.
The Fed's second major tool is something called open market operations, or OMO. This is how they actually get the federal funds rate to hit its target. When the Fed wants to lower rates, it goes out and buys treasury bonds from banks and pays for them with newly created digital dollars. This injects cash directly into the banking system, increasing liquidity. And when it wants to raise rates, it does the opposite. It sells treasury bonds to banks, which takes cash out of the system, draining liquidity. Think of it like the Fed is directly controlling the amount of water in the financial plummet.
And finally, we have the discount window. This is the in case of emergency break glass tool. The discount window is a special lending facility where a bank that's facing a sudden, serious liquidity shortage, like in the middle of a bank run, can go and borrow money directly from the Fed, using its long-term loans as collateral. This is the Fed acting as that lender of last resort. It's the fire station for the banking system, designed to stop a small fire from burning down the entire neighborhood.
Okay, now that we understand the Fed's tools, we can connect this all directly back to bank risk. So what is the single biggest risk factor for the banking system as a whole? It's not a recession. It's not even a wave of bad loans. It's the Fed's own policy, rapidly rising interest rates. History shows us time and time again that Fed tightening cycles are almost always the precursor to stress in the banking sector. And here's why. When the Fed hikes rates really fast, it's like it's attacking a bank's balance sheet from multiple angles all at once. First, the market value of the bank's existing long-term bonds and loans plummets, creating huge unrealized losses. This is exactly what took down Silicon Valley Bank. Second, depositors aren't happy earning 0% anymore. They start demanding higher yields, which jacks up the bank's funding costs. Third, that core duration mismatch we talked about, borrowing short and lending long, gets painfully exposed. And finally, if depositors see those unrealized losses getting too big, confidence can break, triggering the very bank run we just walked through.
So let's put this all together. The reality of our modern banking system is this incredibly delicate balance. It's a system that is profitable because it uses leverage and maturity transformation, but it is also inherently fragile for that exact same reason. Its day-to-day stability is completely dependent on that invisible pillar of public confidence. And because of that fragility, the entire structure is ultimately backstopped by the Federal Reserve, which has to act as both the manager and the firefighter. Every single piece is tied to all the others.
This brings us to the ultimate, one-sentence summary of everything we have just covered. I'm going to read this slowly because it perfectly captures the entire dynamic. Banks make money by borrowing short and lending long, but that same structure makes them vulnerable to liquidity crises, requiring the Federal Reserve to manage interest rates, liquidity, and confidence to prevent systemic failure. That right there is the architecture of modern banking in a nutshell.
Whew, we have taken quite a journey today. From the simple act of making a deposit, to the creation of money out of thin air, to the fatal difference between liquidity and solvency, and finally to the immense power of the Federal Reserve. I really hope this deep dive was valuable for you. Before you go, one last time, don't forget to like, share, and subscribe. And check out the links in the description if you're looking for a real estate agent in your market or you need life insurance. My team and I can help you anywhere nationwide. So I'll leave you with one final thought. We have built this incredibly complex and powerful financial system, one that's designed for profit but is utterly dependent on something as flimsy as confidence. We've seen these crises before, and we know the tools the Fed will use to fight the next one. The final question is, in an ever faster world of information and misinformation, what happens when the next crisis of confidence arrives? Thanks for watching.